Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia, and this evening once again I'm joined by my brother Brian.
Thank you, Darryl.
Partner at As Good as Gold, and tonight we interview Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good evening, Alasdair.
Good morning to you, or good evening to you.
Alasdair, look, can I say that the world's economy remains in a very volatile state, and Donald Trump is out there wielding his big axe, of course, and exercising his authority with a major emphasis remaining on tariffs. If I suggested that he's turned the world upside down, I think it would be a complete understatement. And I guess the interest level from clients, new clients coming through now would support that 100%. People are scared. They're scared, and I can understand why they would be. There are varying opinions at the moment on Donald Trump and his decision to place tariffs on the rest of the world. So I'd like to share some of those comments with you. I don't spend too long about it, but it is varied. We were speaking with Greg Mannarino the other day, and he just thinks that Donald Trump is the worst mistake that America has ever made. That he's making all the wrong decisions. He was very concerned about his obsession, that is Donald Trump's obsession, with lower interest rates, because that just means he just wants to spend and spend and spend and just keep the system going, just debasing the currency at 100 mile an hour. I don't know how much longer that can go before it really has an impact, or we end up with a Weimar Republic again. So Greg wasn't very, very happy at all with Donald Trump. I was interested in a gentleman by the name of Kevin O'Leary, who appears on Shark Tank. I've never brought his name up before, but I was interested in his comments, and what he said was that, he was all in favour. So a complete opposite line of thought to Greg Mannarino, and he said, look, it's not fair. It's not fair. He said, America designs products, produces products, and if it's a successful exercise and they sell 5 million products, the Chinese just come in and say, that's good. We'll copy that. They don't have to design it. They don't have to, or anything like that. They just copy it and produce it for half the price, and it floods back into the American market and puts the American manufacturers under pressure. And I thought, well, that's fine. I understand that. But what he didn't say was that what Brian and I experienced, we're going back in the 1980s, 1990s, where American companies were flooding into China to develop partnerships, produce products at a lesser price, and then sell them back to the United States and other countries around the world at a more competitive price than they would have been able to produce out of their own country. Now, we experienced the same thing here in Australia. We lost all of our manufacturing base. A lot of it went to China, and we were given the opportunity to do that, weren't we? Right. But it just didn't, and we weren't enticed to do so. But the point I'm trying to make here is that America is responsible for the position they're in right now. They're responsible for it. They made the decision to go to China and produce much cheaper goods. Now, China, which was pretty much a third world country there, has grown, they've developed, and they're saying, we don't need you anymore. We can do it on our own. So it was a costly mistake, but it was America's error. He didn't mention that in his presentation. Matthew Piepenburg. And we've got an enormous amount of respect for Matthew, of course. He just said, it's like this. The economy is in a massive bubble. He's been talking about that for a very long time, as have we all. But he went on to say, and he highlighted a number of points. As he said, the repo crisis, where the Fed had to re-liquify the banking system. And then he went to COVID. That was 2019. Then he went to COVID 2020. J-Powell's rate hike in 2022. The banking crisis 2023. 2 wars, Ukraine, Middle East. All of these factors could have burst the bubble at any time. We are in a massive economic bubble, and all it needed was a needle just to burst the bubble. And as he said, that's exactly what tariffs, or the introduction of tariffs, has done. If it hadn't been that, it would have been one of the others or the next major announcement. So I think he's pretty close to the mark. It had to happen. So what are your thoughts about those three responses about Donald Trump and tariffs? Your thoughts, where are we going from here?
Yeah, well, first of all, I'd agree with Matt, pretty much totally. As to the other two, one basically, I would say, is a free marketeer, and the other is, if you like, a macroeconomist. The point about macroeconomics is that it relies on the state for, if you like, guidance. It's if you like, a sort of post-Keynesian concept that the state has a role in the economy running things. But if I can just sort of come back a little bit from that, the problem, I think, is that Trump is a businessman, not a politician, and not an economist. And not only that, but as a businessman, he's actually, I think, quite restricted. I mean, we talk about the art of the deal and all this sort of stuff, but basically he's been in the, if you like, in the property development and hotel industry, as I understand it. And that's the extent of his real experience. He's surrounded himself with others who are pushing their own interests, like, Musk, and that's backfiring on him with Tesla, I'm afraid. But also various other billionaires who in the past have supported the Democrats. Guess why? Because they saw it in their vested interest to do so. I mean, I think the political scene that elected Trump is an absolute mess. Trump, I think, went into this really in the belief that he should do away with income tax and replace that with tariffs. Now, this was the situation before the First World War in America, because really, before the 20th century, America didn't have income tax. The state, the federal government, relied on tariffs as its source of revenue. And that is really what, if you like, Trump was dreaming about when he was elected. And of course, the Make America Great Again, the idea that jobs could be repatriated, manufacturing jobs in particular, could be repatriated to America through tariffs, has enormous electoral appeal. But it's an appeal based on ignorance.
Right.
The consequences of him pursuing this, I think, are, firstly, as far as the tariffs are concerned, it's going to be considerably worse than the Smoot-Hawley Tariff Act of 1930, for the simple reason that in 1930, only 2 or 3% of US GDP was foreign trade, imports, exports, and so on and so forth. It was an economy that was basically self-sufficient. Yet it was the combination of the popping of the Roaring Twenties credit debt bubble and, at the same time, the introduction of the Smoot-Hawley Tariff Act, which was first passed by the House of Representatives in 1929 and then finally signed into law in 1930. It was that combination which really led to the greatest depression ever seen, made considerably worse by government intervention, incidentally. We've still got the government intervention. The point about these tariffs is that there is a far greater reliance on international trade. And not only that, but as you rightly point out, Darryl, American corporations have set up supply chains which have involved China into America, and also have spread since then into other areas. I mean, it brings in most of Southeast Asia one way or the other. If you destroy those supply chains, then the consequences are going to be far greater than the destructive consequences of the Smoot-Hawley Tariff Act in 1930. So that, I think, is really the problem with tariffs. And of course, economists are pretty much united in understanding the destructive force of tariffs. I mean, as they were back in 1930, over 1,000 economists signed a letter to President Hoover saying you must not put this into law. There are a number of economists today who are trying to beat that 1,000. In fact, I have signed amongst them. So I think we'll probably get there. But, you know, it unites economists of every stripe who do understand the destructive consequences of his tariff policy. And of course, the markets reflected this when we saw the sudden collapse in the dollar, and at the same time, soaring bond yields. What that tells us is that the foreigners were selling. And I think particularly the Chinese were selling. There's another element to the Chinese story because the yuan got hit pretty hard. As a result of these tariffs, as you may expect, foreign exchange markets would sell it down. So there was a support operation, if you like, going on with the People's Bank of China to support the yuan. And that has involved if you like, selling dollars and, of course, selling US treasuries underneath. So you can see that this is why you get the falling dollar and the rising bond yields, US treasury bond yields, which is a very, very alarming thing. So that I think is the basis of it. The further problem we have is that while Trump is being thwarted on one ambition, he's not thwarted yet completely, but he is basically being thwarted. He's being wrong-footed, if you like. The second problem is that it's going to be very difficult for him to carry out his ambition of doing away with income tax or reducing it significantly, because all that will happen is that the budget deficit will rise.
Yep.
The consequence of his tariff policies is to drive the US economy into recession. I mean, I would say, as you know, as we've discussed this before, if you take government spending out of GDP, it's already in recession. But the situation is getting worse. And this is generally more widely recognized. I mean, you're seeing the major broking houses saying there's a 60% chance of a recession, which in their language basically means we've already got a recession, if you like. What that means is that revenues are going to be less than the Congressional Budget Office expects, and welfare payments are going to be greater. So you can see that the combination of events is leading to really a very worrying deterioration in US finances. And of course, the consequences of that is to upset the foreigners. The foreigners don't want to have anything to do with America now. I would draw your attention to the agreement. There was a statement from the Chinese that they're now advancing talks quite rapidly with both Japan and South Korea to come to a free trade agreement. So, I mean, what that means is that those two mighty nations have recognized that their future is no longer with America. Now, that's a very, very important thing. Who told them that? Well, Trump did with his policies, with his trade tariff policies. So a lot of damage has been done. And I can't see how that damage is going to be reversed. Trump is described variously as a bully or as someone who won't listen to others' opinions. He won't take advice. And so he's rather, he sort of marches on regardless, steamrolling any opposition out of the way. I think that it was the bond market hiatus that alerted the Treasury to the real danger of Trump's policies. And Trump, I believe, was told by Besant and probably, various others in the US Treasury, look, if you pursue this one, you're going to destroy government finances completely. and you will create an enormous run on the dollar, which is already happening. You've got to back off. You've got to find a way out of this. And that, I think, was why he gave 90 days to, I think, he sort of rescinded the Chinese tariffs for 90 days, saying, give us time, that'll give you time to come and come to an agreement with us, sort of thing, which, well, no comment on that. But I mean, I would say the damage has already been done. And consequently, this is likely to be reflected in the dollar's future. I've already mentioned that South Korea and Japan are now more rapidly aligning themselves with China. They realize that their future isn't really with America. They can see the dangers of America. With the dollar, if you like, becoming unstable, the consequences for all fiat currencies are likely to be significant. And so, if I was in China, but certainly if I was in Japan or South Korea, I would want to distance myself from the dollar's potential problems under President Trump. Now, this for China, I think, is a very important development because it means, as co-ringleader with Russia of the Shanghai Cooperation Organization and BRICS, she is already on her own, well ahead of America in terms of commercial technology. I'm not talking about missile technology, defense technology. The Russians are ahead of America on that. But bringing in Japan and also Korea basically means that the whole of the rest of Southeast Asia is likely to follow suit. So what you're going to have, I think, is a far stronger grouping led by China in particular, and Russia, if you like, as well, Pan-Asian and also across the rest of the world, as other countries who have been reluctant to expose themselves as BRICS supporters or as members of BRICS, beginning to join in more rapidly. So the consequences of Trump's tariffs, I think, are very, very far-reaching. It cements China's future as the, if you like, the commercial hegemon of the world. And it means that America's autarkic view, we're going to bring everything back to America and the rest of the world can forget it. We're going to withdraw from NATO or withdraw our, NATO. We're going to spend less on NATO because we want those damn Europeans to up the ante, whatever. That sort of approach is leading to massive, massive shifts, if you like, in the way the world as a whole works. So that's really, I think, that sums up my view of Trump's tariffs and the consequences of them. And therefore, where the dollar is likely to go, which I guess is going to be your next question. I think
Correct.
I think the dollar is being undermined more rapidly as a result of this than it would otherwise be. And the days of the dollar dominating global trade, I think, have been reduced, shortened. The only thing that we don't have is a replacement for it. And that's the missing thing. So we need really, presumably China and Russia or whoever, to come up with a replacement trade currency. Now, that needn't happen immediately because if the dollar halves, if the dollar falls 90% or whatever, you can still use it because it's credit. You can use it to buy and sell things. You just don't hold on to it. So I think that they will come up with something. There isn't a huge hurry. And it would probably be more defined by the need, particularly for China and Russia, to protect their own currencies from a dollar collapse. And there is the other aspect, which I've only just touched on, and that is the credit bubble. For those who don't understand that there is a huge, great credit bubble and the consequences of it, think in terms of debt. We do have a debt bubble. Of that, I think everybody would agree. but credit is only the other side of debt.
Yep.
And again, if I can go back to 1929, the collapse, if you like, of the Roaring Twenties credit bubble, debt bubble, if you like, and Smoot-Hawley tariffs drove the Dow Jones and the S&P, well, particularly the Dow Jones, down 89% top to bottom over between around about September 1929, which was the top, to the middle of 1932. 9,000 banks either went bust or were closed. And that was why money supply contracted. I mean, it was the destruction of credit on the back of it. What I'm saying now is that this debt bubble is considerably greater in size and therefore consequence when it collapses than the one in 1929. And I'm also saying that the Trump's tariffs today are far more destructive, potentially, than the Smoot-Hawley Tariff Act in 1930. That is where we are.
So what I find difficult to understand, I understand everything you've said, but Donald Trump has advisors, very qualified advisors, that would have had a full understanding of what the introduction of tariffs previously would have, or the impact it would have had on those economies. I mean, why would that not have been taken into consideration? Why would Donald Trump have just ignored, seemingly, all that advice and said, we're going to do it anyway?
I think the answer is twofold. Firstly, the people who he has surrounded himself with are like-minded people, and they're people who when the Donald says jump, they jump, if you like. Mm-hmm. And I think the second thing is explained in one of my comments, and that is that he has a reputation for not listening.
Yeah.
And I think it's as simple as that. Yeah.
That's it. Wow.
I mean, yeah, you know, you know, in the hurly-burly of politics, nobody is interested in history. I mean, it takes a statesman, if you like. In other words, someone who really, I mean, I would say that Putin has got a better understanding, if you like, than anything we've got in the West, of history. History as far as his own nation is concerned. History about the mistakes that have been made in the past and how not to repeat them in the future. We just don't have that. I mean, we've got these democracies which, just become more and more woke. I mean, we're doing things in this country here. We're renationalizing the local railway. I mean, I'm not that old, and I remember the frustrations of British Rail. It was rubbish. A nationalized rail company is the worst possible service you could possibly have in terms of communications. And what is this Labour government doing? They're renationalising, and every as all the contracts fall due, the government's going to take them on. That's their policy. Politicians don't learn unless they're statesmen, and then there is a chance that they will find a way of not repeating the errors of the past. But I can tell you that there's nothing in the West that gives me any confidence in our political lot at all.
Oh dear. Okay. Tell me that with reference to Greg Mannarino's other comment, with his reference to inflation and Donald Trump's obsession with lowering interest rates and just keeping this whole system going. I mean, at the moment, I'm talking with families that are coming into our office. They're earning $200,000 a year, husband and wife, $100,000 a year each. So after tax, they've got $150,000. They've got 2 cars on the drive. They've got an $800,000 mortgage. They've got 2 children that are going to school, and there is nothing left at the end of the week or at the end of the month. Inflation is running rife. We're told that we've got 2.7% inflation. It is an absolute lie. And most people I speak to acknowledge it's probably closer to 25, 30%. If Donald, and it is, I mean, and we've done the exercise many times. So if in fact that is correct, I mean, how much worse could it get? Probably the answer is a lot worse. But could we, if Donald Trump gets his own way and really starts to impact on interest rates, are we heading into another Weimar Republic? I mean, I know it sounds outrageous, 1923. Who'd ever want to go through that? But is it likely? Could we see that? And your thoughts?
Yeah, I think the way to understand it is to look at the debt problem. I mean, government debt is financed at the end of the day out of revenue. In other words, I know the interest gets rolled up, but if you're looking at it from a practical point of view, as a lender, as someone, if you like, being offered the opportunity to buy US Treasuries, the thing that you will be looking at as a foreigner is you'll be looking at the relationship of the debt to the GDP. Now, the point about GDP is that the GDP is the tax base which produces the income which allows the government to eventually pay off the debt, or at the very least stabilize it over the period that you're likely to invest in this debt if you choose to do so. We're now in a situation where debt interest is just about the largest element of US spending. And furthermore, as debt matures, you're looking at something like an average of 3% coupons being replaced with, well, currently 4.5% to 5%. So it's going to get worse, a lot worse. They're talking about something like 9 trillion over the next 12 months having to be redone. So that's the first thing. Now let's look at the economy as a whole. If the economy goes into recession, then, as I say, tax revenue goes down. Welfare obligations rise. So the ability of the government to pay back the debt is even more impaired. If you like, another way of looking at it is that the debt starts growing more rapidly than the tax base. So this is inherently an unstable situation. And that's roughly where we are. And this is something that the foreigners are beginning to wake up to. This is why foreign central banks are selling dollars. I mean, people say they're buying gold, but actually they're selling dollars. That's why. Call it readjusting their reserves, if you like, to account for the risk. So this is obviously patently the risk that they see. And it's not just America. If you look at all the G7 countries, with the possible exception of Germany, and that's going to change, I think, under the new administration, they're all in debt traps as well. We cannot afford to have a global recession, which is what Trump's tariffs are guaranteeing. I mean, I think it was going that way with the credit bubble being burst anyway. But tariffs, it's that combination, which is why I make so much emphasis on the combination of credit bubble plus tariffs is absolutely lethal. So I think that we're going to see higher interest rates. I mean, that's the only way in which a foreigner will finance the government deficit. And it's terribly important because they've got quite a lot of, the US government relies on quite a lot of foreign financing. Something like a third of debt in public hands is owned by foreigners. So that needs to, they need to be encouraged to not only stay, but also, increase their commitment. Now, they're only going to do that at a higher interest rate. But, and this is why it's called a debt trap, you get the higher interest rate, the arithmetic, as far as the foreigner is concerned, gets even worse.
Yes.
Because the debt starts accumulating at a faster rate because of the higher interest rate. And yet at the same time, you've got a contracting economic base to support it.
No.
We had this, and I've said this several times. I think I've probably said it on your shows too, that, back in the 1970s, we had this in the UK. In 1976, we had to be rescued by the IMF. And I remember at that time that despite the economy being in recession, as they call it, I think that's such a misnomer. Despite us being in recession, we had gilt issues with 15% and more coupons. Now, just think what that would do to the US. And I see nothing really to stop interest rates and bond yields rising to those sort of levels again. Unless, that is, Trump actually decides that he's going to have to really cut government spending, really cut it, and raise taxes in order to close that budget deficit. But of course, the Keynesians will be telling him, you can't raise, you can't cut the budget deficit at this stage because that's what's stimulating the economy. So, basically, if he wants to save the dollar, then he's going to have to take that sort of action, and it's going to be very, very painful for everybody.
Yeah. Yeah, there's no easy way out of this, is there?
No, there isn't. I'm trying to think of one, Darryl, but no, I can't come up with an easy way to solve this problem.
But once again, it's history repeating itself. It's taken 100 years to get to this stage, really. I mean, from the time America really took over the mantle in 1918.
Isn't that interesting? 100 years, and we've been talking about 100 years intervals, right from Spanish, Portuguese,
all the way through.
The Dutch, the French, the English, and now Americans. It's always 100 years, plus or minus 10.
Yep. Takes that long to mess it up before everyone wakes up. I guess. And now we've got BRICS, of course, who have responded, and that's growing and developing all of the time. So, America's really got their backs to the wall, no question. In the last part of my question, Brian's probably saying to himself, am I going to get a chance here? But I think I know. In fact, I'm sure I do, but I want your response to this. Just where do you believe? Because gold, silver has stabilised a little. Gold's really performed brilliantly. It's held up seriously well. Kept on breaking records one after another at all-time highs. Where do you see precious metals, gold, silver, heading from here, say over the next 12 months?
Well, I mean, the answer in this is twofold. I mean, firstly, a lot of the rise in the gold price is due to the fall in the currency. I think that's the key to understand. It's not gold rising so much as the currency declining in its purchasing power. Now, having said that, there are various technical factors that are going on which rather suggest that this change in the relationship between gold and dollars or gold and fiat currencies is likely to be a bit more rapid than just the decline of fiat currencies. We have seen a lot of gold and silver migrating out of other centres, the spot dealing centres, if you like, into COMEX. The COMEX warehouses have seen a huge influx of gold and silver, both precious metals. It's a bit of a mystery as to why this is the case. Now, I reckon that the reason it's happened, I mean, that certainly the impending Trump tariffs, if you like, which at that stage were not limited at all. There was no, it was going to be everything. Everything was potentially going to be tariffed. That did produce a problem for COMEX because the system there tends to be short. We understand that the big banks in particular are long elsewhere, but they have the short positions on COMEX. But it's not just the big bullion banks. I mean, you've got the swaps, who are the bullion bank traders, whatever. They have got short positions over there, which they need to cover. So you can see that, the 25% tariffs, which was, I think, the original statement, which was coming out, everything was going to be tariffed. That creates a bit of a panic. And we saw both gold and silver futures contracts go to significant premiums over spot, which created the arbitrage. I think the reason that this was a real problem as well was because of the stands for delivery, which have been increasing in quantity very, very significantly. In the previous 4 years to 2024, I reckon that something like 2,000 tons, I think it was 2,100 tons, had been stood for delivery over all that time. This rate of stands for delivery accelerated very significantly, really from when Trump became elected and certainly from the beginning of this year. So much so that if they continue at the current rate, we're likely to see stands for delivery of somewhere between 1,750 and 2,000 tons for the whole year. In other words, running at almost 4 times the previous rate.
Right.
Now, the problem with stands for delivery is that you may stand for delivery, but you don't actually take delivery.
Weirdly.
It remains in the warehouse. So you can see that, it hasn't come out of the warehouse yet. And if you look at the course, I mean, particularly from the last panic, which was August 2020, following the initial COVID problem, you had the same situation where there was gold and silver flooding into the COMEX warehouses from London. There's a huge, great shortage. There's a panic. The whole thing was an absolute mess. But since then, it declined. So obviously, one of the big factors in this are the stands for delivery actually withdrawing and arranging for their bullion to move out of COMEX warehouses into wherever they wanted to store it elsewhere. That is yet to happen. That is a liability which the system in COMEX has yet to face. Right. It may be facing it already. I mean, I'm sure that the stands for delivery are, trying to get delivery. I mean, you don't necessarily get delivery. You're meant to get it, but there is enough anecdotal evidence that shows that you get delays and delays and delays and prevarication and all the rest of it. And the only way you get it is get a very smart lawyer on it and threaten and be strong enough yourself to be able to upset the system if they don't damn well deliver. So, and it's interesting because at the end of March, there was a stand for delivery of 108 tons, which was a record. Now, it's just one day, 108 tons.
Cool.
So that, I think, is a major thing. Now, that has cleaned out liquidity from all other centres. And there are even reports that gold had been sent from Mumbai to COMEX. Now, Mumbai has this funny system, basically, where you can have your gold in a bonded warehouse and you don't pay a tax on it until you actually move it into the country. So it was that element of bonded warehouse gold, if you like, that was sent over. The other thing, obviously, which did get a bit of attention, was that gold was being taken out of the Bank of England's vaults to satisfy this arbitrage, if you like, it being sucked into the COMEX warehouses. So much so that there was a long queue to get delivery. I mean, we were talking about a queue going to the end of this month. Now, the point about that is that you will find that bullion banks do have accounts at the Bank of England, but the vast majority of the bullion that they store is stored for central banks. We don't know, but it's a reasonable supposition that some of the gold that went out, if not most of the gold that went out of the Bank of England's vaults, was leased gold. Right. Because as a lessee, you own the gold until the expiry of the lease.
Right.
Now, the point is that you have got central banks who, for the last 4 years, have been increasing, if you like, as a cohort, their reserves at the rate of about 1,000 tons a year. And the situation appears to be accelerating. We don't know because, of course, we don't get the figures. We only get the figures, we're told what they want us to tell us.
Yes.
I think it's reasonable to suggest that the rate at which central bank gold is being increased has itself increased. Now, it makes no sense, therefore, for anyone in the central bank cohort to lease gold, particularly when you think about what happened to the Bundesbank, which was that was 2017, when they tried to get their gold back, and the delays that were involved in that, etc. And you begin to think, if you're a central bank, I don't think having my gold in London or in New York or even in Paris or Switzerland is necessarily a good idea. Now, I might leave it there. I might try and get it back home if I've got somewhere to store it. But the one thing I don't think I should be doing is leasing it.
Yeah.
Now, the point is that there is a lot of gold being leased, and it has the effect of creating two owners.
Is that?
And probably more. Because if I can lease gold, let us say, and lease it for a year, or even lease it for 5 years, then I can rehypothecate it. And someone else will rehypothecate it from there. So, this could have multiple owners. The point is this leasing, even though the gold in the past hasn't left the Bank of England's vaults, it's this leasing that provides the liquidity for the market, for the bullion market. This leasing, I believe, is drying up because no central bank with any sense is going to continue leasing. And as these leases become due, that gold will be withdrawn from the market.
Right. Yeah.
So really, the answer to your question, as I say, is twofold. Firstly, you've got the dollar and other fiat currencies going down of their own accord, making it appear that the value of gold is rising, but actually it's just the price, not the value, that's rising. And the second thing is, I think there are internal problems in the market which actually could end up in big systemic risk.
Yeah. Yeah. Well, I'm looking at it and I'm thinking if gold is up 50% in the last 12 months, you can, I think you've got every reason to believe that it's going to replicate that over the next 12 months. It has, I can't see why it wouldn't. I cannot see the economy improving over the next 12 months.
No.
So gold's only got one direction ahead in, and I think we're in for a very exciting time for gold holders.
I'm glad you're excited, Darryl.
For gold holders.
for gold holders, I'm glad you're excited. I'm looking at my watch and I'm thinking, gee whiz, I might get one question in. But
the floor is yours.
Before I get to the next question, which I'm thinking about anyway while you were talking, there's two things. We talked about standing for delivery. And I had forgotten about standing for delivery, and I understand what Alasdair is saying. I know who's going to stand for delivery. Do you know who wants to stand for delivery? Fort Knox. They don't have any gold. They're trying to get as much as they possibly can. But
that's another very valid point. I mean,
but we're not going to go there.
No,
we're not going to go there. But, and one other point, Alasdair, is that I was actually doing it this morning. I was watching your latest Substack, and you were talking with a gentleman, I think from Metal something or other. I'm not quite sure the heading there, but anyway, he said, Alasdair, the trouble is when I'm talking to you, I get demoralised. I know you're telling me the truth, and it's quite true. I mean, it's quite true. The truth is starting to come out. And the whole bottom line is here.
It's demoralising for non-gold
holders. Of course. Because you haven't got an answer. You have not got an answer. I know I've been told you can't eat gold and you can all this sort of thing. You can't eat dollars either.
No.
Doesn't matter how many dollars you got, you can't eat them. So, anyway, to my next question. Right, okay. Alasdair, look, with the price of silver over a gold to silver ratio of 101 to 1, that's the last time I looked at it. 101 ounces of silver buys 1 ounce of gold. It leaves physical silver grossly undervalued. With the price just over, with the price just under $32 an ounce, what do you expect silver over the next 2 years? What do you think it's going to do?
Okay. Well, firstly, I mean, the gold-silver ratio is ridiculously high, and I think that we will see that come down. Silver, I mean, obviously, central banks are not buying it. This is, if you like, the surface difference between the performance in gold and silver. Central banks not interested in silver; they're only interested in gold. So you can see why, if you like, from that point of view.
Yeah.
The ratio has risen. Now, there are other aspects to this. If you look at what's been going on in COMEX, yes, there have been shortages, but the bulls have been buying silver really on the basis, not of its monetary qualities, but because they believe that, the Silver Institute says it's a supply deficit for the last 4, 5, 6 years, whatever. And on top of that, of course, you can see that, all this sort of photovoltaic cells and all, the demand for silver, the industrial demand for silver is still rocketing. The military demand is fantastic, etc. I mean, this actually should be going a lot higher on industrial grounds alone. And the interesting thing is that it's performed in the futures market very, very differently from gold. In the case of gold, we've seen the price of gold rise while open interest has contracted, which implies there was a huge, great bear squeeze.
Brilliant.
If you look at the relationship between open interest and the price in silver, however, both of them have tended to rise together. I mean, there have been times when it hasn't been quite like that. Now, that, if you like, is classic bull market move, if you like. It's the sort of thing as a stock trader I would expect to see, when I see a rising price, if I see rising volume underneath it, I would say this is healthy as long as it doesn't get too overbought. Yeah. In other words, the rising volume is an indication of more buyers coming into the market and pushing the price higher. So that's the fundamental difference in the performance between gold and silver. Now, what it meant was when the shakeout happened, 2 weeks ago, they bashed the price of gold. They couldn't get it down very far simply because the buyers were still there, physical buyers, etc. But in the case of silver, there were paper bulls, speculators, who were long of contracts, who got stopped out. And that was why the price fell considerably more heavily than you would have thought. And that, I think, is part and parcel of what has driven the ratio between gold and silver up to over 100.
Yes.
Now, if you look at the chart of silver, as a technical analyst, it actually looks brilliant, because what it's done is it's come back and it's tested the top end of a consolidation period which lasted 4 years, and that has held. And furthermore, the moving averages are in bullish formation. So what you've seen is just a slight overshoot on the downside. And this has been, in effect, a very quick but major correction. And it looks like this could now go to the races. The only thing that really, on the chart, creates a little bit of a pause is the 35 level, which it got to not so long ago. And it's got to break that. Once it's broken that, then, a bull would say the sky's the limit, if you like.
Yeah.
Though I think there is quite a lot of catching up for silver to do, given the circumstances. Now, I would also expect silver to begin to show some, what I call moneyness, if you like, in the price, because with a deterioration of the situation with the dollar and other paper currencies, fiat currencies, then obviously you've got to consider forms of money which have no counterparty risk. Now, there is nothing in the silver price for that at all. There should be. There should be, because I mean, if we go back to historic relationships, I mean, apart from the fact that the gold-silver ratio was around about 15 when silver was fully recognized as money, you had some countries on a silver standard, others on a gold standard. It's just basically when Germany went off a silver standard and went on to a gold standard in the wake of the Franco-Prussian War, 1873, around about then, that the silver price collapsed relative to gold. But until then, it was very much money. Now, legally, in England and Wales, under the gold standard, the silver was legal tender for up to 40 shillings. Now, 40 shillings doesn't sound like a lot, but when you bear in mind that a pound was a sovereign, exchangeable for sovereign, even as late as 1932, then with the sovereign around about £600 today, then you're looking at silver being legal tender for up to £1,200. That's the current legal situation. It makes sense insofar as if we see the end game of this, I mean, however long it takes, we don't know. That's yet to be found out. But if the end game of this is that it's the end of the fiat currency era, and we go back to a system whereby the value of circulating credit is tied to gold, then you are going to have something for smaller change. If you're going to have any coinage at all.
Yeah.
If you see what I mean.
Yes.
I mean, you could, in theory, say, okay, we won't, we'll just have paper money. We'll just have electronic money. That's it. Yeah, maybe. I mean, that could be the answer. But if there is any movement towards coinage or, smaller denominations, then I think what you're going to be looking at is silver coming back in some form or another. But that £1,200, if you like, gives you some idea as to what the relationship would likely to be if silver did come back and was used as a form of legal money as opposed to credit. So I think silver looks very interesting here. The other thing I did notice, I've known for a long time, or I have believed for a long time, and I have seen evidence which certainly suggests it, that the Chinese have been controlling the market. Going way back, I was speaking at a conference in New York, I think it was 2012, 13, something like that. And there were a load of silver miners exhibiting at that conference. And I asked all of them the same question. How do you turn your silver dory into cash to pay the wages and the fuel bills and everything else that you need to operate your mine? And they all came up with the same answer. They said, a man from Glencore comes along, he assesses the value of the dory. We get paid on the basis of that by a bank, which I would guess would be JP Morgan, working with them. And it's then shipped off for refining. Okay, where does it go to be refined? And say, well, it's none of our business really, but I suspect China. And we were pretty certain that it was all going to China for the very simple reason that refining silver is not a very ecologically friendly operation. And many countries like Canada, for example, they were cutting back on refining, even though they were major gold and silver producers. So this basically meant that China has been trying to corner the silver market. And of course, because it doesn't go through, the dory doesn't get through the market, it's only priced relative to the market. Guess what? You need to work with someone like, I guess, JP Morgan in order to keep the price down so that you're not paying too much for your dory. And the way you do that, quite simply, is you sell futures contracts.
Right.
Which is, on behalf of the People's Bank of China. They're the customer. So, and that was managed, if you like, I think. I mean, I think in this sense, the commodity department was working as a broker with sort of semi-discretionary powers. You'd have a once a quarter meeting or whatever with the client who let's assume it's the People's Bank of China, and you agree the strategy, and you agree, we're going to have to hedge this month and do it at such and such a time as to keep the price down. So, you had these sort of hits, if you like, the whole time on the silver price, which worked brilliantly. And then I saw that, and the latest figure was 2023, China supplied the amount of silver, which was almost exactly the deficit on the Silver Institute's estimate for 2023. In other words, and the other thing is that where did this go? The major centers taking Chinese silver were London, Hong Kong, Singapore.
Right. Yeah.
Now, I don't see them really as major consumers of silver.
No.
But I do think, unless I've got it wrong, that they are financial centers.
Yes, financial sense. Yeah, very, very true. Absolutely.
So I think China, but I mean, it does raise the question. Sorry, if I can just continue a little bit. How does China's policy go from here? And I think this tariff thing could have changed actually quite a lot of thinking in China as well. Why the hell should we keep prices low for these bastards who just want to tariff us out of existence?
Yeah.
I mean, if I was the People's Bank of China, I think I would probably step back from the market and say, well, tough, mate. It's your problem.
Yes.
Well, again, Darryl, I just think silver is just a great second set of money supply, and I think it's going to do incredibly well over the next couple of years. And it's always about the dollar going down and gold and silver remaining the same, but it just takes more gold, more silver to buy the same ounce.
Well, as I read it, as the demand increases, and we're noticing that now, gold for some people will become unaffordable, and silver is their best option as an alternative.
Yeah, absolutely.
If you've got $5,000 to invest in precious metals, then silver's probably your go. And I can see, as the population at large really focuses on precious metals, that we're going to see a lot more for that reason investing in silver.
Yeah. Okay.
Sorry, can I just add to that, Darryl? I mean, now that we have gold having broken out into new high ground and all the rest of it, there's bound to be a feeling amongst the investing public, if you like, that they've missed the boat.
Yes.
But
Yes.
silver is still there. So I think it's, it'll be seen as the cheap way in, if you like.
Yes.
Yeah. Sorry, I interrupted.
No. 300. Yes. No. Thank you.
Since 1971, President Nixon takes us off the gold standard and all hell's broken loose, right? You can say whatever you like about currencies and paper currencies, and it goes to derivatives, it goes to all sorts of money printing. The more they're printing, the worse it goes into.
Yeah.
So if we have a look at past history and have a look at, basically the gold standards of the past, the only times gold standards don't work is when government gets involved.
Yeah.
So the whole thing is, I think Alasdair believes 100% the gold standard is necessary. There will be some hurt along the way, but it will be a very quick hurt, and countries that go back to a gold standard will actually boom ahead. Okay, Alasdair, the last question for this evening, I want to do an explanation, and it's something that you've talked about many times, or certainly I've seen it many times and I love it. And then I'm going to do a physical demonstration of what it really all means. And this is an article some knowledge that you brought out a few years back, and it's all about, the question was going to be, will the US wake up that the world reserve currency is not a good place to be, and allow gold to take over that role? Now, the following are examples of how gold is versus currency, the difference between gold as money and currency as money. Right. So we're going to concentrate on oil, steel, copper, and manufacturing. So let's say oil, and these figures are from Alasdair, so they're right on the money.
Yep.
1950 to 2022, The US oil is up 39 times. So in this 70-year period, you've got a barrel of oil up 39 times. Now 39 times, by the way, is 3,900%. In that same period, if that barrel of oil was priced in gold, it would not be up at all. It's actually down 30%. So in 70 years, the price of oil has come down. Lovely for people who want to drive motor cars. Copper, this is from 1900 to 2022. Alasdair says the in US dollars, copper is up 27 times, 2,700%. Gold, down 70%. So you build a house. All that copper that goes into a house, right? It's cheaper now than what it was for the last 100 or so years, 120 years. Scrap iron and steel, 1934 to 2020, in US dollars, it's up 69 times, 6,900%. In gold, pricing, scrap iron and steel price in gold, it's the first time it's gone up, it's 32%. 32 as against 6,900. You can see what I'm saying here, folks. Priced in gold, having a gold standard minimises the price of goods going up. Now, I'm going to talk about car manufacturing, and this is manufacturing here in Australia. We recently had about 6 motor car companies, and they all fizzled out at one point in time. But the latest ones, General Motors, Ford, Toyota, lasted till 2017. Now, I'm just going to take you back to Henry Ford, right? Because in 1908, Henry Ford, just think about these US dollars, if you want to look at it this way, the Australian dollar. This is a $20 Australian dollar bill, right? $20 Australian dollar bill. And this is 18 of them. But the US Federal Reserve, or the United States, was on a gold standard. And the net fact of the 18 $20 bills, which is $360 for a Model T Ford, actually cost 18 ounces of gold. Now, I've got 18 ounces of gold here. I'm going to put these here. There's 5, there's 10. Now we've got another 4. And another 4. 18 ounces of gold. 8 and $360. That's what it took to buy a motor car. Now, if you have come forward from 2008, when that Model T came about, to right now, or 2017, it is close enough. All right, this is the sort of increase in currency we have to pay. Right, so we've gone from $360 to $50,000. They're all $20 bills. And to be more effective, we can go like this. And that's how much you would have to pay for a Ford motor car. Today's language. Now that's up 12,500% is the increase in currency. 12,500%. Now, what is it in the price of gold? We got 18 ounces here, right, to pay for that in 1908. I'm going to take these 8 away. You got to remember, we're taking them away, not adding to. You can buy that Ford or General Motors motor car for 10 ounces of gold. What was 18 ounces in 1908, 18 ounces of gold is now 10 ounces of gold. That is the power of gold as currency. And you can't deny it. These are the facts. I love how the gold standard makes currency absolutely ridiculous. Why go to paper currency when you're carrying all this stuff around when a few little coins can buy you a motor car? So that's basically my demonstration. I've used this demonstration in a number of seminars. Everybody comes up to me and says, I didn't realize it was, paper currency was like that. But that's what it is. Paper currency destroys the value, right, of everything you buy. I think, Darryl, you could end it up with...
Oh, look, I'm just blown away.
Yeah, But you've got a lovely one on if you went to a supermarket 1 year ago,
No.
And look, you just tell the story there.
Oh, no, just very, very quickly. If you went to a supermarket, and I put this to everyone, when we're looking at inflation at 2.7% per annum, if you went to a supermarket a year ago and you bought $100 worth of food, and you went back again today, 1 year later, and you bought the same amount of food, would it cost you $102.70? No, of course not. It's going to cost you somewhere around $130, maybe $140. Some people tell me $150. But that's how scary inflation gets. But of course, we're lied to in addition to that, at 2.7. But inflation is scary when it gets away from you, and this is just a wonderful illustration of that, and the role that gold can play in a wealth building exercise for you.
Yep. All right.
Just I guess, and just finishing, and I once again, I'd like to. We had twice as many questions as we've actually asked, Alasdair, but I think the important thing here is, just to close, many years ago, and I keep telling the story, Brian and I met a gentleman by the name of Charlie Tremendous Jones, and he said something that stayed in my mind and Brian's for the rest of our lives, and that was, he said, in 5 years' time you'll be in exactly the same position you're in right now, apart from two things: the people you meet and the books you read. How correct he was. Jared is my son, of course, but Brian and myself committed to meet as many people as we possibly could that would educate us and take us to another level. And obviously, right now, we're speaking with Alasdair Macleod, who is recognised as an amazingly smart man when it comes to economics all around the globe. And you can connect with Alasdair. That's the important thing. Alasdair is an advisor to As Good as Gold Australia, but he can provide you with information that can take you to another level. Alasdair, how can people make contact with you if they want to take advantage of your services?
Well, I run a Substack column, which is called, you find it on at alasdairmacleod.substack.com. If that's the spelling of my Scottish name defeats you, then go for Macleod Finance and Google it, and that will probably take you there. And it's, as you say, I'm trying to make as many people as possible understand what is actually happening to their dollars, their pounds, their euros, their yen, whatever their currency is, and why it's happening, and therefore have some idea as to how they can, if you like, preserve their wealth. I mean, we've gone from the days, I think, of speculating to accumulate, or however you like to describe it, grow your wealth. We've gone from there, and it's understanding that, yes, we have gone from there, and now it's a question of protecting your wealth, preserving your wealth. Yeah. That has got to be your priority in these very, very difficult times. And as I said earlier, Wall Street in 1929, same circumstances today. Wall Street lost 89% of its value top to bottom. Don't get trapped in that. Don't get trapped in that. Yeah. Don't listen to the brokers who say, I've got a good idea for you. But actually, one thing I will say is that even though it was the gold standard and all the rest of it, one of the best performing stocks was home stake mining in America. Mm-hmm. So, I think you'll find that the investing institutions, because gold is not a regulated investment, they have an argument with the compliance officer if they want to buy gold. So they will buy ETFs instead, but also they will buy mines as a leveraged way to get into it. And I think you're going to see big portfolio shifts, if you like, towards the mining sector. So that's something also which I think, as well as having the real stuff, which I think is got to be your core position. I think to actually take the mining sector very, very seriously is also important.
Yeah, that's so true. Alasdair, I would recommend that every single viewer that is watching this channel connects with you And so
on your Substack
on
channel.
Substack,
Yeah.
and just take full advantage.
Highly recommended.
It will take them to another level. Look, thank you again, Alasdair. Really appreciate your input, and we just look forward to our next interview with you. I'm also thankful of our viewing audience, our viewers, subscribers. They continue to support this channel, and we're thankful for that. And I guess all I can say now is until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.